Hello there guys. So in this video I'm going to go over three economic indicators that I believe are the best to follow Forex with. Obviously this should be part of your framework of all the different indicators that you look at for Forex. However, these three are the ones that I like the most. Obviously Forex can be quite complicated with all the macro data, so distilling it to a few that you really like does make life a lot easier. Um, um, so without further ado, let's get on with those indicators. So the number one that I like to look at is bonds, and this can be updated daily. And so what we're looking at here is a spread between the European 10-year bond and the United States 10-year bond. And depending on which way the Forex pair is, so if it's Euro USD, you'd do Euro divided by United States, etc., or just download the spreadsheet from the Google Drive link below. And when you get that spread, you get a difference between obviously the two bonds. And as you can start to see here, there is some similarity. And when you sort out the axes, so for the last business cycle, you can see it clearly does lead the up and down movements for the Euro USD. And so that's great for us as traders because it helps us time and enter positions. But why does bonds show this? Well, effectively, a bond is whether you have faith in a certain company or a region or a country here in this instance. And so if you have more faith in one country, then it's more likely that more dollars is going to go in that area. Why would you have more faith in that region? Well, their economy is doing better. If their economy is doing better, then there may be a potential for interest rates increases, in which case you'll get yield off of your money, so you're going to have fund flows going into that direction. Conversely, if the other nation is not doing so well, money will be leaving that nation to go into the other pair. And so that's what would happen in the bonds initially, because those pricing things a lot quicker, and then sooner or later you see those moves in Forex pairs. So that's the Euro USD, but does it work for others? Let's have a look. And here we have the pound, and you can clearly see against the dollar, it really does work. Um, Again, here's the Australian dollar. Once again, really does work. New Zealand dollar, again, once again, it works very well. So those are the G10. Does it work with, say, emerging market countries? Say, okay, here's the Brazilian real. And yes, once again, it has a striking ability to show the price movements. Does it work with, say, the Turkish lira? Yes, once again, it's moving there again. And what about the ZAR? Yeah, it's there as well. It's got it all right again. So if that's not enough, we can just then Google search. Here we go. Are bonds a leading indicator for Forex? The first research result is open, and we can go to the top and says bond spreads a leading indicator for Forex. Well, isn't that handy? And then we have the Australian Aussie dollar here and how you can go about doing that. So, so that would be for the for bond yields, and these are updated daily. And the best way of doing that is with what I have is a Metastock subscription. There's a link below. You can update the entire spreadsheet and just by a click of a button, and then you'll get the bond yields all straight into your one spreadsheet against the Forex pairs, and that should make life a little easier for yourselves. The next one I want to show you is something called Forex reserves. So what are Forex reserves? So essentially, the dollar is the world's reserve currency of the world. That's a statement of fact. And 80% of all Forex, or 80% of all international exchange, international exchanges are denominated in US dollars. Therefore, the amount of US dollars you have is very, very important. Once this tends to go negative, that means you have a shortage of dollars, and when that happens, your currency tends to get destroyed in the forex market, for the loss of a better phrase. Obviously, the dollar is a unique case, so when that tends to go negative, then you could have a recession or a risk-off environment, in which case the dollar really appreciates. So if we go to the Australian dollar, we can see as it goes negative, the Australian dollar gets smashed. As it goes positive, the Australian dollar really ramps up, and then once it starts to go negative again, or momentum is lost, it crashes, and then we have a rebound, and so on and so forth. New Zealand dollar, exactly the same behavior. Let's find where's GBP. There we go, and we have the same behavior there as well. So on and so forth. Does it work with emerging markets? Of course it does. So if we go to the try, again, obviously the scales have changed over time, so you'll have to zoom in, just do a copy and paste job. So it goes negative, boom, goes positive. We have some semblance of stabilization. Then once it starts to go negative, it just depreciates like mad. Same with the ZAR, again, went negative, and that's a large move for Forex. These indicators updated monthly. So this is the international Forex reserves. So uh, international Forex reserves on a year-over-year basis against GDP. So you can source this data from elsewhere, but it is the majority of the data is still found on Metastock. You may get the reserves not against GDP, in which case you can just divide it by the different Forex pair. It should work out just fine as well. So I think that's all I need to say on the Forex reserves. If this isn't fully fleshed out for you, you can just Google away on what international Forex reserves are, why they're so important. But basically, you need a certain amount of dollars, and obviously, a lot of the world's debt is denominated in dollars, so you need to pay in dollars. If you're running out of dollars, your currency and your payments internationally are going to be very, very difficult. Why in dollars? Because it's the world's reserve currency. It's the most trusted currency. And for the foreseeable future, despite what many people say, it is going to be the world's reserve currency. Who else would you trust? Um, so that being said, I think I've gone over the reserves there, and it's updated monthly, and also leads definitely the Forex pairs. So the next one then would have to be capital account balance as a percentage of GDP. So so the capital account balance is basically telling you how much money is coming in or out of a country. And this comes out quarterly, so it tends to lead Forex moves by at least a quarter or so, or it leads more so than the Forex reserves. So first, yeah, so that's the order in which you would want to use it. But once again, don't be limited here. Do look at other indicators. They are just one indicator, and indicators are fallible. So as you can see, once it's gone negative, we have massive moves in the dollar going forwards. And so these tends to be a risk off for here. And with the Australian dollar, once it tends to go positive, then we can have gigantic moves in favor of the Aussie dollar, and vice versa. Does this work for New Zealand dollar? Of course it does, just like it has done for the other ones. Does it work for, say, the try? Yes, of course it does. It went negative, and look, we had gigantic moves. Went negative there, gigantic moves. ZAR, does it work for ZAR? Yep, of course it does. We had a peak out here in positivity. It transitioned to negativity. Often you're looking out for the peaks in positivity and going into negative once it does that, and you can see gigantic moves once again. Again here, gigantic moves once again. So this is just once again the capital account balance as a percentage of GDP on a year-over-year basis. If you can't find that data, then the capital account balance for the country divided by the different country you're looking at, plotted against the Forex pair, should also work very, very well. So just in summary then, the three indicators are bond yields, as we see here. So bond yields, I tend to do the 10-year versus the other 10-year, but you can experiment with 5 years, whichever bond yields you wish to look at. So it's the 10-year versus the 10-year for international Forex reserves, and then the capital account, current account balance for different nations, and then the differentials from that if you can't find the percentage of GDP for the capital account balance and for international Forex reserves. Once you've got those, in my opinion, you should stand to be able to see the Forex moves for pretty much any nation. definitely say 30 or so nations, so many different trading opportunities there. And also you would just need to do some research on the forex market itself, which ones are risk off currencies, emerging market currencies, etc., and really study the nations and how they're built up. Hopefully this video has helped. Add this to your framework. Don't think that you can use this in replace of anything, but hopefully this will help you with your trading. Again, they are just free indicators, and do your diligent research yourself. That being said, guys, please do like the video, share the video, subscribe to the channel, and I'll see you in the next one.